Good morning, ladies and gentlemen. This week we shall go the other way round. We shall start with the biases and what we wrote last week and see how the week developed and what to expect, which is new. We basically said 5 to 10 year notes, sell rallies and short volatility, that any up move in the futures, i.e. down in yields, is going to be very limited, but also the converse is true. We are in a period of low volatility where rates are stabilizing at a higher level, and therefore being short of vol is the right thing to do. Very much the same for the Europeans, with 131.40 level capping in the bubble. That is naturally for March. We will now put in the June volume level later on. SPX, we wrote this, any higher than 2760, which we got on Friday, gives us 2800-ish gap fill. 2700 to 2680 should hold. 2681 was the low for the week, and 2620 is the absolute line in the sand, below which it turns into something very nasty potentially. We never got anywhere close to it, so we're fine. Now we're adding that 2818 to 25, it should be the top of the range, and should be the top of the range for quite some time. Not a week, not two, but probably a good month to 2 months. NQ, the opportunity, it is the buy against the other sectors. And what happened this week? Well, we had a breakout in NQ which closed at new highs, while the S&P and all the other contracts are lagging badly. We shall go and have a look at that, and that ratio spread, which we don't think stops anytime soon. In terms of volatility, we said it closed below 1980. We have stability. Price movements will not be nearly as vicious as for the past 2 weeks, and now it's below 1650 and more stability. This is all that we wrote last week's, and it will last. This stability should last between 8 and 10 weeks before we have another potential shoe dropping in volatility, because as we've seen and we'll see again, volatility events tend to take place in pairs. And the super cycle of cheaper EM in new stocks apart from XLK, and the butterfly XLK, SPY, EM is still the position to hold. Absolutely nothing has changed there. The dollar, as we said, ending diagonal most probably. Any spikes are a buy either way. We're looking for stability. Basically 88, 92 to 93 is your 5% range for the foreseeable future. Certainly into the late spring and early summer. Don't be wary of selling or buying DX on spikes. You have to trade a range. This is now a range bound market. And now let's have a look at what happened and what will happen next week. Absolutely nothing to add here apart from what we have added. 28.18 to 25 should be top of the range for SPX. Everything else still stands, especially the range in DX. And this butterfly, which is, we've come to the conclusion there is no perfect time to put it on. It's in a trend and will continue to be so. If we look at a daily chart of the SPY, we will notice that we are coming very close to the top of the Bollinger Bands. This might go slightly up on Monday, but this is basically a compression, and really one should not be surprised to see the market trading no higher than this gap fill, somewhere around 28.10 in the futures. Would be surprised to see the top part of the gap fill up to 2840-ish. That should not happen for a while. The first gap should get filled, and then we should go back and test just below the levels on Friday around 27.15, 27.25. We will have reactions such as this from the top of the Bollinger Bands, I'm sure, because everybody will be long. Everybody is again getting long, and that will provide the ammunition for a move back down to below the 50-day moving average towards the lower Bollinger Band. But that is still stability. It's still a range-bound market. 28.15, 28.20 should be enough on the upside before we go and test 2700 again. And the sectors which we'll now look at confirm that. This is XLF. As you can see, the market is right at the top of the Bollinger Bands. It would not be surprising to see this reverse into this area around 28.93, 28.95. We think that could happen Tuesday, Wednesday, Thursday of next week. It should come back in. As you can see, this is a constriction, and the Bollinger Bands here are not lying. It will not go up and stay up. It might go up and come straight back down. So XLF, which is approximately a quarter of the S&Ps, telling you that it's not going into trend. Even if you were going into trend and we are completely wrong, it'll take several days of price action here around these current levels to enable the Bollinger Bands to widen out and for us to have a move higher, which is very much what happened here. We had a spike, and then we came back and we traded in a range for 2 days before we started trending up. Well, we don't think that's likely to happen. What is likely to happen is that we basically just spend a couple of days up here and come back and fill this gap around 29.05. That is what we are looking for, and that is quarter of the S&Ps. The other really important component in the S&Ps is XLY, and this is a chart of XLY, identical price structure to the XLF. We could just see a spike of this level, just take out the shorts, and then come straight back down to the moving average around 104.14. So exactly the same price structure in XLY as in XLF, confirming our analysis. XLI. Now XLI is again confirming top of Bollinger Bands, a few ticks higher, half a percentage point or so. We closed at 78.45. The Bollinger Bands will be 78.91, so less than a percent. We don't think this high gets taken out or even tested, and XLY comes back down and the Bollinger Bands constrict. We will be trading in this range around between 75 and 76.50 for several weeks, we think, before the market is ready to make any new move. And now the most bullish sector by far, and the only one that made a weekly new high, which is XLK, our favorite sector, but even this one has a constricting Bollinger Band up here. If we have a look at a closer, oops, don't know what happened there. Let's try it again. We can see that we are at the top. We are within 0.25% or 0.5% of the top, and we would not be surprised to see a move all the way back down to I don't know, 68.60 or so, which would be nice and healthy, and that would basically be the cherry on top. This move would actually make S&P swoon all the way down to 2700 from the level that we're at. So really every single sector is confirming our view that we are within 1% at the moment, or maybe 1.5% of the top of the range. Don't forget, XLK is by far the most bullish, and when it comes back and tests this line around the 68.50 area, that will be yet another opportunity to get long of it against SPY. As if we needed any more confirmation, this is the Qs, daily chart of the QQQs. Very, very close to the top of the Bollinger Band. Almost not worth playing. 173.75-ish is going to be just about the top. This is going to be some kind of a diagonal. It is going to play around here and come back down towards 167.5. Again, everything is pointing towards a move towards the top of the range in the S&Ps, just above 2800, for a move back down towards the 2700 and all those gap fills below. If we look at the weakest index out there, that is the Dow Jones, the one that has retraced the least. You can see how far away it is from the top. You can see the constriction in the Bollinger Bands, and you can see that this is the price action that we're going to get for quite some time. It is basically a range-bound market now. Around 25,600, 25,800 is going to be the top, and the bottom is going to be this moving average for the time being, around just above 24,500. Even the weakest suggests that we are range bound, and even the strongest, the Qs, do that. Don't fight it. Do not be long above 2800. Very, very dangerous to be long above 2800 in the S&Ps. Moving on to the dollar index, we are now, even in that one, seeing a constriction in volatility. You can see the Bollinger Bands are now going to turn, and we are going to have a constriction, and we are going to trade somewhere around the 91.60 level as an average. That is going to be where all the moving averages are going to be in several weeks' time. Probably wait for the 200-week moving average to turn. That 91.60 level we think will be seen, and then this will be some sort of a fourth wave. We have a 1, 2, 3, 4, 5, now an ABC, and then we resume the downtrend sometime in the summer. But we have several weeks, probably 10, 15 weeks of price action somewhere around the 91.60 area before we are ready for another leg down. All of which confirms that if the dollar gets slightly stronger, you will see some pressure on the S&Ps. So anywhere around 2800 is a good area to let go of it now and wait for cheaper prices. The sectors confirm, and even the dollar confirms. If we look at a chart of the 10-year note yield, you'll see that exactly what we thought would happen with the Bollinger Bands constricting is happening. The Bollinger Bands are now beginning to open up, so there will be more pressure to the upside than to the downside, we think, but it's going to be very limited. If this is the end of the third wave, and now we've done some sort of an ABC down, all we need is a slightly higher high, probably around the 3,305 area, and then we are ready to do a fourth wave and come back in. We are so far away from the 200-day moving average that would make sense to just make one more high, get everybody bearish the futures, everybody selling the whole, and then come back in here around the 280 to 3% area and remain there for several months. That to us is the most likely outcome of the 10-year note, and therefore even that indicates stability and indicates that S&Ps are not going to go too far away from their current valuation. Where you could have slightly more upside than in the S&Ps is in the Europeans. It's not going to be spectacular. Here we have an hourly chart, and we have some retracement levels We are now coming up towards the 38.2% retracement at 34.52, and we have some gaps still to fill around the 35.23 area, which is just between the 50 and the 61.8%. If the dollar is now going to be slightly stronger and therefore the euro slightly weaker, it would make sense for this market to start edging higher. It has been a much worse performer than the S&Ps. That could change for the next few days while this market reacts higher, but then it's a much better sell up here than a buy, and we could have some real fun if we manage to fill this gap around the 35.23 area. We will definitely be looking to short it between 35.40 and 3500, looking for much lower prices later on in the year. Certainly a retest of this 3036. If we look at a daily chart of cash stocks, we get the same picture. We've turned the 200-day moving average. Therefore, any move around 34.80 to 35.30 is going to be a very low risk sell, and then we should have a very good reaction down towards 3200. This is all confirmed by the charts of volatility that I'm about to show you now. And this is a daily chart of the VIX. As you can see, we are approaching the lower bound of the Bollinger Bands, and we have now turned the 200-day moving average. So if we come off, well, not even 1%, we are going to have huge support, and that's definitely somewhere that we would love to be long of volatility, long of calls and volatility for a move back up towards 20. So again, this is confirming. If we can have a look at this area, you can see that 13 is about as low as this market will go. We closed at 1470 on Friday. Anything even anywhere close to the 13s, we will be buyers for a quite strong reaction to at least this kind of area 17, and that is telling us that we are going to move from around 2800 to 2700 in double quick time. If we draw a line through this, we can see that that is supporting, and this is a diagonal, so the ending diagonal eventually should break higher, but probably in many days time. And finally, I want to leave you with the weekly chart of volatility, which basically shows you that volatility comes in pairs. You have however long in between, but you still do have at least a pair event to it. It's hard to see that any occasion where volatility has spiked, like it has spiked a few weeks back, is not at least retested. Have a look on your own at your VIX weekly chart. Count the bars in between. Roughly, it's 8 to 10 weeks. And that coincides with hello, the end of April. And you know what they say, sell in May and go away. That could very well be what we are about to see, and it could be starting next week. 2800, 2820, whatever it might be, to us is very much the top of the range, and it's worth being long of puts and long of volatility for a twin event sometime in the next 6 weeks or so. Thank you very much indeed, and tweet you on Monday.